This is the fifth sample lesson for the Series 7 Top-Off Study Guide, audio lessons for the new Series 7 exam. This lesson is on the Securities Exchange Act of 1934, and it's a long lesson, 40 minutes and 14 seconds in total length. Make sure you understand the Securities Exchange Act of 1934. Welcome to the Series 7 Top-Off Exam audio lessons. This is lesson number 6, and in this lesson we're going to be covering the Securities Exchange Act of 1934. Today we're going to be talking about the Securities and Exchange Act of 1934. This is the act that regulates the secondary trading of securities. When you think about the Securities and Exchange Act of 1933, think about initial public offerings and what is required to make full disclosure in offering the stock to the public. When you think about the Securities and Exchange Act of 1934, think of regulating the market in trading of the issues after they're out there in the market trading. So this is the act that regulates, among other things, brokers and exchanges, but primarily it determines how stocks are traded in the United States, what is prohibited, what's not prohibited, and what are fair trading practices. So the Securities and Exchange Act of 1933 and 1934 were pretty much passed at the same time. The Securities and Exchange Act of 1934 established the Securities and Exchange Commission, and both these acts, both these laws, both these rules came about as behavior by broker-dealers that, let's just say, was less than honorable prior to 1934, which led to the Great Depression, the crash of the stock market, and the Great Depression. So these basically changed they changed the trading practices of a lot of broker-dealers. Before 1934, I should say, before the crash of 1929, a lot of insider trading was taking place, and that is one of the big aspects or the big changes that was brought about by the Securities and Exchange Act of 1934. Interesting. There's very, very strong prohibitions against insider trading except for one special group in the population, and that special group seems to be our politicians. Our politicians, our senators and congressmen, have exempted themselves from insider trading rules. In other words, they can profit on all the insider trades that they can come up with. And who is in a better position to find out who's going to be awarded government contracts? There was a big to-do about this a few years ago. Congress changed the rules, and then guess what? They changed them back again. So these rules apply to everybody in America except for our representatives. Interesting. They seem to think they have a special right to be able to profit on insider trading. In my opinion, that's not right. All right, enough from my editorial comment. Let's get on with what the Act talks about. Again, it established the Securities and Exchange Commission. What the Act does not apply to, and none of these, the Securities and Exchange Act applies to non-exempt securities. Exempt securities in the previous podcast, and exempt securities are municipal bonds, government bonds, private placements. I think basically that's about it. So the SEC Act of 34 does not apply to exempt securities, so it applies to non-exempt securities. It regulates trading practice and reporting requirements of brokers and exchanges. We'll go into that in detail. It goes into great detail about insider trading and insider rules. It has prohibited transactions. It deals with company financial reportings and proxy statements, what is required and what's not required. And that's pretty much it in a nutshell. But let's go into the details of what the Securities and Exchange Act of 1934 talks about. The Securities and Exchange Act of 1934 was amended in 1988, and I'm going to talk about it as if it is amended. I don't think you have to know what was amended, but you need to know what it includes now. In the Act, there was one sort of catch-all rule, and this is probably a rule you need to know. It's called the 10-B-5 rule. And basically, it's a catch-all rule that says if it looks like a duck, or walks like a duck, it quacks like a duck, it is a duck. In other words, just because it's not prohibited in the Securities and Exchange Act of 1934, if it looks like fraud and can be proved as fraud, it is prohibited. So it sort of takes the idea that this is the spirit of the law, and even though an action may not be specifically prohibited, if it appears to manipulate stocks or get around insider trading rules or basically smell bad, it may be prohibited under this rule, under the 10-B-1 rule. So just because I don't talk specifically about what is and what is not prohibited doesn't mean it's not prohibited. Okay. Let's first of all talk about, and this is probably one that you're going to be tested on fairly extensively, is what defines an insider. That rule was changed to be much broader than the initial rule. In the initial rule, an insider was considered an officer and a director and anybody with at least a 10% stock holding in the company. Later on, an insider was expanded to include anybody that has non-public material inside information on the company. But under the classic definition of the term an insider, there are specific rules of trading for officers, directors, and 10% stockholders. But trading on non-public material information would be insider trading. So if you have non-public material information on a company that you trade on, that's considered insider trading. Proving it's another thing. There's been a lot of talk, a lot of activity by the SEC to try to prove insider trading. So far, their conviction rate is fairly mixed. Well, let's just go into some practices that I've seen in hedge funds over the last few years. Several hedge funds put together expert consultants, or a group of people they would call up on specific companies, specific industries, and try to gain knowledge on those companies. Now, these wouldn't be the officers or directors of the companies, but they may be project managers, they may be highly placed of the company that under the old term were not considered insiders by the definition of the original Securities and Exchange Act of 1934. Well, because they didn't fit the classical definition, some of these hedge funds went out and said, well, let me interview you and pick your brain about what's really going on that you're seeing is happening with the company, and gathered market intelligence or company intelligence in that way. Now, to me, that's basically doing your research. But the SEC has sort of come down and said, no, that's gaining material non-public information. And the hedge funds that traded on that have been prosecuted. Now, how much of this can you do in the course of due diligence and how much can't you do? That's a big gray area right now. Actually, some hedge funds contacted me because of my particular expertise in a specific industry and asked to talk to me. I declined. I didn't really have the time. I didn't consider it illegal, but it may have been an illegal act if I had passed on some of that information. I didn't think the information I had was that particularly valuable and wasn't non-public in material, but the SEC seems to be trying to expand the definition of material non-public information much broader than it would have been interpreted in the past. So this is a big gray area that you need to consider. I consider calling employees and talking to them, doing my due diligence and doing research in companies. Just because a company or just because an employee works at a company and can tell me what he's seen does not necessarily give me an accurate picture of the overall company, but it may give me a picture of a specific part of the company. So that's a concern of mine and something you need to be aware of. But let's go back to what the classical definition of an insider was and what they can and can't do, because this still applies. It's just that insiders are now much more broadly considered. So the insiders that apply to these rules that I'm going to be talking about are officers and directors of the corporation and 10% stockholders. Now, insiders that fall into that category those insiders cannot short sell the company stock. That's a big one. They're not allowed to short sell the company stock. However, they are allowed to short against the box. And what does that mean? Well, shorting against the box means that if you own a position of a stock and you want to lock in your profit or loss, then you can short the equivalent amount of shares that you already own. Now, why do people do this? Most often people do this in order to move a taxable event from one year to another year. And it locks in that taxable event at the current prices. So, for instance, let's say in December 1st, you had a profit in a stock, but you wanted to sell that stock, but you didn't want to pay taxes on that stock, or the tax rules changed the next year. You could sell the equivalent amount of shares that you own and effectively lock in the price on that stock. Because if the stock went down, you would make it on the short position. If the stock went up, you would make it on the stock and lose it on the short position. So it effectively keeps you in the same place for a period of time. So insiders in the classic definition, officers, directors, and 10% stockholders can short against the box, but they can't take short positions on the company's stock. What about the company? What about the accountants and lawyers? Well, they actually have been found in several court cases to be considered insiders. It's not codified, but it has been found in several cases that the accountants and lawyers of corporations that they do work for do have access to material non-public financial information, and trading on that information makes them an insider. So there's been some court cases that say that they are not allowed to short sell stock as well. So insider trading is a fairly gray area. So what if you happen to know an officer or director of a public corporation, and he says to you, well, I can't trade on this information, but hey, I'm going to tell you something, and you might want to take advantage of this information. Well, that's considered inside information, and if you trade on that material non-public information, are also considered an insider. So there's a tipper and a tippee rule. Both fall under the rules of insider trading. So when can officers, directors, and 10% stockholders and people with material non-public information trade on that information? Well, the answer is once that information has been made public, then you can trade on that information. Prior to that, you're considered committing insider trading, which has some significant fines. And there's a couple definitions for what the fines could be. If it's just a person who trades on insider information and not an officer, director, or a control person, what's called a control person, an officer, director, or 10% stockholder. If it's just an individual that trades on inside information, that fine can be up to $5 million and 20 years in jail. If it's a control person, then it can be up to $25 million and 20 years in jail. Who gets the money? The Treasury Department. And let's say you have a buddy sitting across the desk from you that happens to overhear you talking to one of your clients and getting some material non-public information, and that he sees that you trade on that information. If he reports you to the SEC, he can collect a bounty of 10% of what the SEC gets from you. In addition to the SEC, people that are harmed by insider traders can sue insider traders. So it's not limited to the government suing insider trading. If an individual has been harmed, he has the right to bring an action against the inside trader. So it's not just the SEC that can bring actions against inside trades or inside traders. Let's talk about what companies are required to report. Once a company is out there trading on the market, they have to file several reports. These are required reports by the SEC. First of all, there's the 10K, which is the annual report. Then there's the 10Q, which is the quarterly report. And lastly, there's the 10C, which is the 10C is a report the company files if it changes its name or if there's a 5% or greater change in the number of shares outstanding. And that has to be filed within 10 days of the occurrence. And there's one other report that has to be filed. That's the 8K, and that's if the company files for bankruptcy, changes the composition of its board of directors, there's a merger or divestiture, and if any of those events occur, that has to be reported within 4 days of the event, 4 business days of the event. The 10K and the 10Q report, a lot of the information contained in those is financial information. There's going to be the income statement, the balance sheet, the cash flow statement. Those have to meet generally accepted accounting principles, GAAP. That's called GAAP. The 10Q, they are non-audited. Those are quarterly reports, and those are not audited. The 10K is an audited financial statement. Public companies are required to get audited financial statements on an annual basis. And I read annual reports pretty regularly, and there's a lot of information that's contained in the annual reports. And nowadays you can also, when the company is making its quarterly results known, they will quite often have a conference call, and you can listen to those conference calls if you wish, and you can gain a lot of information, usually in the question and answer section of the conference call. Quite often they'll open it up for Q&A, and analysts can sometimes ask some fairly probing questions that might give you a little insight into the company. And of course, acting on that information is okay because that is public information. The SEC Act of 34 also changed the ways margins and loans are made by brokers to its clients. That now falls into the Federal Reserve Board's jurisdiction, and there's 2 regulations that regulate margins. The regulation of margins from brokers to their customers is regulated under Regulation T, and the regulation of credit extended to banks and brokers is Regulation U. Don't know that you need to know much more than that, except Regulation T you will deal with on occasion, because what will happen is if your client falls below margin restrictions, and we'll have a podcast that deals with margins later on, but it's always Regulation T you're dealing with your clients. All right, the Act of 34 regulates exchanges. Now, what are the exchanges? Well, there's physical exchanges and there's electronic exchanges, and the Act regulates both of those exchanges. The physical exchanges, the big difference between the physical exchanges and the electronic exchanges are the physical exchanges, and we're basically talking about the New York Stock Exchange, the Pacific Stock Exchange, the Philadelphia Stock Exchange, and the Cincinnati Stock Exchange. The physical trading floors have specialists, and specialists have books, and specialists are required to make markets for stocks and provide liquidity for stocks. You can read up on what a specialist does on your own time, but the bottom line is trading floors have specialists that have their own books of orders, and that's non-public information. And they are required to provide liquidity to stocks even if there's really a mismatch between the bid and the ask. That's the job of a specialist. In an electronic exchange, that is all done electronically. You will see bids and asks, and the dealers that make the bids and the ask have to stand behind those bids and the ask, and you can see how many shares are willing to stand behind on each bid and each ask. And once those bids and asks are filled, new bids and asks come into play. So that's totally done electronically. There's a couple other exchanges out there. There's the alternative trading system, and it's sort of a quasi-exchange. It's a small private network of broker-dealers and other participants. And then there's the Electronics Communication Network, and this is basically totally anonymous matching of buy and sell orders. It's a black box. Institutions quite often will use all 3 exchanges, the listed exchanges, the ATS, and the ECN exchanges, if they're trying to move a large block of stock, because running it all through one exchange may affect the price of the stock more than they would like. The Act of 34 authorized the formation and the registration of national securities associations, and these would have been the NASD, the NYSE, but pretty much that all falls under the FINRA. The NASD merged with the New York Stock Exchange in 2007, and where those two were two separate self-regulatory organizations, they became one, and that one is now called FINRA, which stands for Financial Industry Regulatory Authority, and that's who conducts the SIE examination. The Act also set forth specific rules for proxy solicitation. So the Securities and Exchange Act of 1934 regulates proxy solicitations and defines what has to be included in a proxy solicitation. When you get your proxy statement, the information that's contained in the proxy statement is not necessarily the same information you'll receive on the 10K and 10Q reports. And the one big difference is a lot of the proxy statement is devoted to the compensation of officers of the corporation. And you don't see that in the annual report. So if you want to see how the officers and directors are paid, you need to go to the proxy statement. Also, if the company wants to raise additional shares or sell additional shares, change its charter, by selling additional shares, they would have to get an authorization to increase the number of authorized shares. Now, if the shares are already authorized, they can always sell those shares in a secondary offering on the market. But if they need to increase the number of authorized shares, they have to do that in the proxy statement. So proxies are regulated under the Securities and Exchange Act of 34. The Act also requires that people that acquire, individuals or institutions that acquire a 5% ownership in a company's stock are required to report that within 10 business days of acquiring a 5% ownership. And then at that point in time, they need to make a statement on what their intentions are. If they are just intending to be a passive investor, then they file a 13G. If not, then they need to make their intentions known. This prevents sneak takeovers of companies. So let's talk about how the Act regulates broker-dealers. Well, first of all, it requires that broker-dealers register with the SEC. And it also requires that the broker-dealers maintain a minimum net capital, and part of that has to meet what is called minimum liquid capital standards. You're not going to be asked what those capital standards and requirements are, but you need to know that they are required to have a minimum capital and a minimum liquid capital as well. They are required to segregate fully paid customer securities. And what does that mean? That means if you go in and buy a stock and pay 100% for that stock and you don't borrow against that stock, that's considered fully paid customer securities. If you margin your stock, there's different rules for that. They are required to buy back stock for customers that have reneged on their transactions within 10 business days. This is going to happen to you at some point in time in your career. You're going to have a customer that calls you up and says, I've got the stock certificate, I want you to sell the shares, and then that customer goes on vacation and forgets about delivering the stock certificate to you. When that happens, the client's account is restricted. The broker has to go in and buy back that position to cover that position because the broker cannot deliver the securities that were promised. And most of the time, if there's a loss, they're going to hit you, the broker, up for that loss. There's a rule that says know your customer, and that's always the catch-all rule that says, hey, if you screwed up, it's your responsibility because you didn't know your customer. Some brokers may help you out, some broker-dealers may help you out, but my experience has been when that occurs and there's a loss, it comes out of your paycheck. If there's a profit, it goes to the firm. So you can't play this game and make a profit on it. It only costs you money. It works both on the buy side and the sell side. If a client buys a stock and doesn't pay for it within 2 business days, that's the requirement for the settlement of a stock trade. But if he doesn't do it within 10 days, then the firm has to go back in and and cover that trade, to sell that stock. And again, if there's a loss, you pay for it. Say your client has some money in the brokerage firm. This is pretty common. It's just sitting there in the money market funds waiting to be used for purchases. Companies have to give an accounting of that. They have to receive at least a quarterly notice of the money sitting in their account. And for the most part, companies, broker-dealers, they're required to send out at least quarterly statements. And if there's activity in the account, they send out monthly statements. Broker-dealers are allowed to let a client opt into electronic delivery of confirmation and statements. On a semi-annual basis, broker-dealers are required to send customers a copy of its audited balance sheet. The income statement's not required, but the balance sheet is. Broker-dealers are allowed to pay for order flow and to route trades to specific dealers. If they do that and they make a payment for order flow, this has to be disclosed to customers, and that's done in the confirmation. There's a trade and tick. Once in a while, you may have a fast market, and if you have clients that are trading into this fast market, they may not be happy with the executions they receive. And they may call you up and say, hey, when we talked, the stock was trading at X, and when I bought it, geez, it's Y. What happened? And you are allowed to get the broker-dealer to provide a trade and tick. And what that will show is all the trades that occurred in a stock for a period of time, and shows when your customer's transaction took place. I've done that in the past. You'll have it happen. This usually solves any issues that you have with your client. Broker-dealers are not in the business of playing favorites. Usually it's first come, first serve on trades. It's pretty much standard. But clients are allowed to ask for that. That's called the disclosure on request of routing of customers' orders. And they can go back 6 months to get this information. Now, there's a document that broker-dealers make publicly available, and that's probably you'd find it at the company's website. That's a quarterly report that details the routing procedures and the payments for order flow. All right, now let's talk about specific unlawful practices under the Act of 34. Wash trades, buying and selling to try to create the illusion of volume in a stock. Front-running customers, if you know that there's going to be a bunch of trades coming to the market, you can't place an order front-running that batch of securities. Manipulating stocks, acting as a group to move a stock up or down is prohibited. Giving false information to induce a buy or a sale of a stock is prohibited. Going and blogging about a stock is a gray area, especially if you're providing misleading information. It's probably illegal. If it walks like a duck, talks like a duck, quacks like a duck, it is a duck. So that falls under that big catch-all rule that we talked about earlier. Accepting payment for telling clients that a stock's likely to go up or down is illegal. Pegging a security is illegal, except in the case of an initial public offering. Brokers and underwriters are allowed to buy and sell stock to try to stabilize a stock. That's during the period immediately following an initial public offering. After the initial public offering date, after that quiet period is expired, it is prohibited to buy and sell stock to try to peg a stock. You have to let the market go where it wants. So what are the statute of limitations on insider trading and manipulation and unlawful practices? Suits can be brought within 1 year of discovery, and the statute of limitations is 3 years. Now, any of those prohibited practices we talked about is considered manipulation, and that's considered fraud under Section 10 of the Act. All right, the last thing we're going to talk about are penny stocks. There's some special rules regarding penny stocks, and here's what they are. And this really comes down to boiler room operations, where companies are calling and touting stocks. And these are solicited orders we're talking about. These are not unsolicited orders. So if you call a client and get him to buy a penny stock, and a penny stock is defined as a stock selling at less than $5, not traded on the NASDAQ or on the listed exchanges. these are bulletin board stocks or over-the-counter stocks, then you are required, before you sell this stock to a client, to obtain detailed information about that client's financial situation, their experience, their investment objectives. You are required to know your client. That's a know your client rule. Then you are required, based on that information, to determine whether this investment is suitable for that client. And then if you make those two determinations, before you can effect that transaction for the client must receive in writing your assessment of his financial condition and why you think this investment is suitable for him, and he must sign that. And if he disagrees with the analysis, then he is told not to sign that, and that's in boldface. Once those things have occurred, then you can sell him the stock. Now, there's some exclusions to that. First of all, if he's an insider or if he's an officer or director of the corporation, that's not required. If he's an accredited investor, it's not required. If your firm doesn't really deal in penny stocks and it accounts for less than 5% of revenues, that's not required. And if it's an unsolicited order from your client, that's not required. So you will have clients that call you up after going to a party and drinking too much the night before, talking to a friend that tells them about a great penny stock that's going to go up that they just heard about and learned about, and they want you to get in on the good news. Well, you're a huff saying, hey, I need to buy this stock right away. And usually what I've done is say, whoa, why? And they usually think they have some special inside information. And I say, well, hold on a second. Let's actually look at the company. And I'll go and pull out the financial statements of the company and really do some discussions with the client about what the company is and what the company is not. Most of the time, these are blue smoke and mirror hype stocks. I usually talk my clients out of these transactions. I've rarely been sorry, and the clients usually have been thankful. So be careful on buying penny stocks for your clients. At least make them step back and look at the financials of the company. Usually the financials are non-existent or so appalling that anybody buying these stocks would be considered an idiot. But that doesn't stop some people. All right. In addition to what you've just learned about the Securities Exchange Act of 1934, there are a few things specifically contained in the outline that apparently you have to have some understanding of. And I'm going to address those here. We're talking about Section 15C2-12, which is called Municipal Securities Disclosures. I'm going to summarize that for you. So this is talking about disclosures about a municipal bond that occur after the initial issuances of the bond. So this is going to be reflecting the financial health or operating condition of the state, local government, or the municipality as it changes over time, or specific events that can have an impact on key features of the bond. It requires that dealers, when they are underwriting municipal securities, certain municipal securities, those in excess of $1 million primarily, to enter into an agreement to provide information to the Municipal Securities Rulemaking Board, the MSRB, about the securities on an ongoing basis. So annual information that's required is operating information provided by the state or local government, the audited financial statements for the state or local government, or other obligated persons if available. They need to notify of any of these events, any principal or interest payment delinquencies, any non-payment related defaults, any unscheduled draws on debt service, which might reflect financial difficulties, substitution of credit or liquidity providers or their failure to perform, adverse tax opinions or events affecting the tax-exempt status of the security, modifications to the rights of security holders, bond call and tender offers, defeasances, release, substitution or sale of property securing repayment of the securities, rating changes, bankruptcy, insolvency, or receivership, merger, acquisition, or sale of all issuer assets, appointment of successor trustees, financial obligation, incurrence, or agreement if it's material. In the event of a default, the acceleration, termination events, any modification of terms, or other similar events under the terms of financial obligations of the obligated person, any of which reflect financial difficulties. So let's talk about the time frame for submitting these disclosures. First of all, the annual disclosures must be disclosed annually on a specific they agree to. And the other disclosures must be submitted to the electronic municipal market access website within 10 days of the event. So here's the exceptions from this rule. The entire issue is for less than $1 million. The bonds are sold to investors in authorized denominations of $100,000 or more to no more than 35 sophisticated investors. The bonds are sold in authorized denominations of $100,000 or more and mature in 9 months or less from the initial issuance. The bonds were issued prior to July 1995 or prior to December 1st, 2010 for certain puttable securities. Where can you find this information? The MSRB EMA website is a publicly available website which displays continuous disclosure information submitted since July 1st, 2009. So that's where you'd go to, the EMMA website, Municipal Securities Rulemaking Board's EMMA website. All right, that's all you need to know, or probably more than you need to know about the Securities Exchange Act of 1934, Section 15C2-12, entitled Municipal Securities Disclosures. And the other one we want to talk about regarding the Securities Act of 1934 is Section 15C3-3, entitled Customer Protection, Reserves, and Custody of Securities. All right, this one's fairly complicated, but I'm going to read right from the Securities and Exchange Commission website. The Customer Protection Rule Initiative, CPR initiative, is intended to address historical or ongoing violations of Section 15C3 of the Securities and Exchange Act of 1934 and Rule 15C3-3. As described under the CPR initiative, broker-dealers that have failed to comply with customer protection rules may self-report to the Division of Trading and Markets and the Division of Enforcement of the U.S. Securities and Exchange Commission. If an enforcement action is warranted, the Division of Enforcement will recommend favorable settlement terms for self-reporting broker-dealers. Then it goes into the background. The Customer Protection Rule seeks to avoid, in the event of a broker-dealer failure, a delay in returning customer securities, or worse, a shortfall in which customers are not made whole, by requiring broker-dealers to safeguard both the cash and securities of their customers. Its requirements work to achieve this objective by eliminating the use of broker-dealers of customer funds and securities to finance firm overhead and such firm activities as trading and underwriting through the separation of customer-related activities from other broker-dealer operations. For customer cash, Rule 15C3-3 requires a broker-dealer to maintain a reserve of funds or qualified securities in an account at a bank that is at least equal in value to the net cash owed to its customers. The amount of net cash owed to customers is computed pursuant to a formula contained in Exhibit A to Rule 15C3-3, while the formula itself embodies a simple concept for the responsible stewardship of customer cash. If a broker-dealer owes more to its customers than its customers owe to it, the broker-dealer must set aside at least an amount equal to that difference so that it is readily accessible to repay customers. All right, basically that's it in a nutshell, and the rest of this that I'm looking at the website is talking about how firms go about self-reporting, and other things that deal primarily with the broker-dealer in maintaining compliance with this act. But basically it says that broker-dealers have to set aside money equivalent to the cash owed its customers. All right, I think that's a good enough summary of this section. That finishes up what we're going to be talking about of the Securities Exchange Act of 1934. This is going to come up many times in future lessons, so make sure you understand this. All right, thanks for listening to this sample lesson. If you decide you want to purchase the full bundle of audio lessons, go to the series7podcast.com, and that's series and the number 7, so series and the number 7 podcast.com. Click on the Series 7 Top-Off Study Guide, audio lessons for the new Series 7 exam, and it will take you to a service called Gumroad. Gumroad will take your credit card information and then send you an email link where you are allowed to listen to or download the MP3 files. Let me strongly suggest, that you take the time to download the individual audio files into your computer. The total length of this full series of audio lessons is 32 hours and 27 minutes. So download all the MP3 files to your computer and then take the time to upload the individual MP3 files that you want to listen to back to your listening device. This would take up a lot of storage space to put the full series of audio lessons onto your listening device. I provide in the download a PDF document which explains how to go through the process of downloading the MP3 files to your computer and then uploading them into your listening device. And I'm assuming by listening device, you're talking about an iPhone or another smartphone of some sort. You can also do it into the old-fashioned iPods if you want to do that. Gumroad does have an app which you can use to listen to the audio lessons, but I think you will have a lot of problems using the app. It has not been updated in quite a few years. I'm hoping that Sahil Lavinga, the founder of Gumroad, will be upgrading this app in the near future. But until then, if you want to purchase the full series of audio lessons, the best way to do it is to download it into your computer and then upload the individual MP3 files into your listening device. Now, a lot of people have asked me why I don't put the full series of audio lessons out on, let's say, a service like Audible or iTunes. Well, if I did that, they take such a big portion of my revenues that I would probably have to more than double the price that I charge you for this series of audio lessons. I try to keep the price reasonable and affordable to you. And if I uploaded it to those services, I just wouldn't get enough to justify the trouble that I go through to put these audio lessons together. All right. Best of luck in your if you find these audio lessons useful.